So that we will be now taking FDI 1, session 5, because I am not familiar with their slides. I am fully familiar with the subject. Don't worry. So what is FDI? Made by a person resident outside India in equity of an unlisted company or greater than 10% of the post-paid-up capital of a listed company or in the capital of a limited liability partnership. तो देखिए 3 तरह की investment आई. FDI can come directly into a private limited company or a closely held public limited company. That money is coming directly to the company, or 10% or more of the post-issue capital of a listed company on fully diluted basis. What do you mean by fully diluted basis? That there could be warrants, there could be convertible debentures, there could be other convertibles. उसके हिसाब से जब full conversion हो जाता है, उसके बाद जो fully converted capital अगर 10% से ज़्यादा है, only then it is considered as FDI. Otherwise, it is FPI. It is otherwise foreign portfolio investment. Less than 10% is not considered as for FDI. In capital of a limited liability partnership में अगर पैसा लगाते हैं तो that also is also covered now. It is permitted. Foreign investment made directly or indirectly. Investment may be made through equity or quasi-equity instruments by a person resident outside India. What is quasi-equity instrument? As was been explained by us earlier, that any instrument, भी इसी में बताया उन्होंने, any instrument which is fully convertible. The concept which is used is compulsorily and mandatorily convertible debentures or fully compulsorily and mandatorily convertible preferential shares, or any other instrument which is fully and mandatorily compulsorily convertible into equity is considered as good as equity. And anything which is partially convertible or which is optionally convertible, it is all considered as external commercial borrowing. ठीक है ना सर? तो वो तो कंसेप्ट उन्होंने ECB में हमें बताया अभी. एलिजिबल फॉरेन इन्वेस्टर, अब कौन कौन बाहर से इन्वेस्ट कर सकता है? इंडिविजुअल्स कर सकते हैं, कंपनी कर सकते हैं, बॉडी कॉर्पोरेट कर सकते हैं. दीज आर द three categories who can invest into India. There could be foreigners, there could be foreign nationals, there could be Indian nationals living outside India, there could be body corporate, there could be companies. Category 1 automatic wherever required. The FDI was allowed in the 100% automatic route from the following categories. देखिए लगभग सभी कैटेगरीज के लिए FDI was 100% allowed. Free automatic route. When so it was without permission, it is a permission, but permission is automatic. Then we have take it like this. The manufacturing sector, cash and carry also trading, e-commerce because restrictions have we talking about them. Non-banking financial companies, single brand retailing ये discuss करेंगे. I think single brand retailing and retail trading is also permitted. Pharmaceutical greenfield is permitted. Which is required. Now continuing to only route. But obviously government revenue is required. Defense up to 74%. Under automatic route, rest under government route. Multi-brand trading up to 51% under automatic route. Above 51%, of course there are certain conditions also. There is one category of FDI in which no question being asked, you can invest up to 100%, there are no conditions which are attached. For example, manufacturing sector, there are no conditions attached. But there are several sectors where there are performance linked conditions or there are sectoral caps. What is a sectoral cap? That particular sector, there is a cap, maximum cap which a family can invest and a family provider can invest. They are called sectoral cap. For example, in roof repairs or in insurance companies where they have sectoral caps which are there. And in every sectoral cap, when there are conversions, for example, defense sector, there are sectoral caps, but there are famously conversions also. In Ministry of Defense, a year when many etc. where 7% which are prescribed. So I think that of course might be covered later, but I think this is a broad category where what we are saying is. And full products retail trading, 100%, but this is through government route. Pharmaceutical up to 74% under automatic route, rest under government route. That means if you have a brownfield project up to 74%, what is brownfield, what is greenfield? Greenfield is when you are setting up a new project. That is greenfield. And when you are acquiring an existing operating company, it is called brownfield. Category 3 is of course prohibited sectors. Chit fund, trading in transferable development rights, real estate business, activities or sectors not open to private sector investment and foreign technology collaboration. For example, railway is not open to private sector investment so far. So, and foreign and atomic energy is also not so far open. Foreign technology collaborations. Now, I think next comes FDI from land bordering countries. Before I deal with the land bordering countries, if there is any other issue on FDI which is troubling you, because primarily, देखिए real estate business मैंने बताया, real estate business is buying and selling of real estate is considered as real estate business. Nothing else is real estate business. अब आप real estate construction करते हैं, फार्म हाउसेस को छोड़ देते हैं, उसको वो अलग प्रोहिबिशन है. उसके अलावा मान लिया आप बिल्डिंग बनाकर बेचते हैं, आप एस्टेट इंडस्ट्रियल एस्टेट बना के बेचते हैं, वेयर हाउसेज बना के बेचते हैं, या वेयर हाउसेज बनाते हैं आप खरीद के अपने लिए उसे रेंट आउट करते हैं, वो सब इसमें नहीं आता है. रियल एस्टेट इज आपने खरीदा बेचा, दैट इज रियल एस्टेट बिजनेस. दैट इज व्हाट इज इन द प्रोहिबिटेड सेक्टर्स. वो सभी के लिए प्रोहिबिटेड, सारे नॉन रेजिडेंट्स के लिए रियल एस्टेट प्रोहिबिटेड है. हिंदुस्तानियों के लिए भी विदेश में रियल एस्टेट बिजनेस में इन्वेस्ट करना प्रोहिबिटेड है.
And those shareholders have the foreign shareholder, I think now the company have to alert shareholders.
Foreign shareholders, yes.
This company NOA talks about the buying.
The press note 3 of 2020 made amendment to Rule 6. And this will be all investment from land bordering countries will be made only through the government approval route. Relevant extract of the resolution, of course, they have given. Primarily, all countries which have land bordering, which are land with whom we have land borders. Which includes, of course, Hong Kong also. China का पार्टी मानते हैं उसे practically because that is governed by China. उसमें कुछ confusion था. Otherwise, नेपाल या जितने भी अपने land bordering है, चाहे बांग्लादेश है, चाहे पाकिस्तान है, चाहे बर्मा है, I think all of them, if they want to invest into India, then definitely it requires a prior approval. There is a detailed procedure, and Ministry of Home Affairs as well as Ministry of Finance, both of course, give various ministries give their comments depending on what is the nature of investment, which area are you investing, which is the administrative ministry. वो सब जगह उसकी copies जाती हैं, and then accordingly that is considered at a very high level committee. That in the event of transfer of ownership, not only at the time of investment, but also suppose the ownership is transferred, you are transferring ownership of a person who is having a land border with India. Then also you definitely require same approval route one has to go through, and there is a detailed procedure. The formats hai, all those formats you have to fill up, and then it is a matter of few months. Sometimes it may come, sometimes it may not come, depends on whether it is in the interest of the country or not. I think that is the primary thing which the government of India primarily examine. But हमारी experience है कि अगर in normal course के जो project है उनमें किसी में उन्हें कोई दिक्कत नहीं है. It is only some specific area which they want to prohibit. Entity of a country which share land border. India share land border with 7 countries: China, Bangladesh, Pakistan, Bhutan, Nepal, Myanmar, Afghanistan, referred to as specified countries. China, of course, has the largest share. Now, question of beneficial ownership also arise. Beneficial ownership, whether you are, what is beneficial ownership, of course, not defined, but normally it is defined as 25% earlier, now 10%. That means if more than 10% interest is of there for a person who belong to China or the land bordering countries, then it will be considered as having beneficial owner from that country. If it is less than 10%, then it will not be considered. अभी पहले लिमिट 25% की थी, पर अभी घटा के उसे 10% कर दिया है भारत सरकार ने. Recently they have done. And beneficial ownership limit, I think for all purposes, they have reduced from 25% to 10% for FEMA purposes.
I'm sure sir covered what is FDI. So the basics of FDI, then I'll just jump on to the slide which was actually, presented before you. So India in 2020 introduced regulations, what we most of us refer to as PN3 regulations, or land bordering investment regulations. So basically what happened during COVID, and India was actually trying to impose some kind of restriction on the investment that was coming in from China. So COVID actually presented an opportunity to them. So what the government did was they came out with the regulations where they said that where any investment is coming from any country which shares land borders with India, that will require approval from the government of India. Basically what it meant was any investment coming from Pakistan, China, Bangladesh, Nepal would require approval from the government of India. Now, this was clearly directed towards all investment coming from China because Pakistan and Bangladesh were already restricted. Nepal was restricted to some extent. And they were not receiving any FDI actually from Afghanistan. So it was directed towards China. So any investment that is now coming in any sector, and whether it's goods, whether it's services, it does not matter. It requires approval from the government of India. practically there are about 400 applications that were filed. And out of that, about 50% were filed in the first 6 months of these regulations coming in. But the government has so far granted approval to approximately 80 or maximum 90 of these applications that have been made. I also actually filed about 5-6 applications. Out of that, we have got approval only for 1. It's not like the government has rejected the balance of it. The government is moving very, very slow. And these actually applications are all investments from China, from no other country. So whenever there is tension at the border, the government actually stops all the work with respect to granting approval, so that they also use it as a pressure tactics on the Chinese government, and therefore there is restriction. The process is very, very stringent in terms of getting the approval. The maximum time that goes into this approval process is that government actually scrutinizes each and every investor that is sitting in China, which is making investment into India. So it can be a direct investment, it can be an indirect investment from China. You need to go and take an approval. And the government actually, the Indian consulate in China actually visits the office of the Chinese investors and investigates, interviews them before granting any approval. So this we've already covered. So the government actually said on the beneficial ownership side that any investment which is beneficially owned from land bordering countries. But they did not define what is beneficial ownership. But beneficial ownership is defined at multiple places in the regulations. It is defined under Companies Act, it is defined under Money Laundering Act. And also the DPIIT, which basically grants approval for the investment into India, also in their standard operating procedure has mentioned that you need to borrow the definition from Companies Act. So the Companies Act definition is that where any individual owns more than 10% in a group, then that he or she becomes the beneficial owner. And therefore, we have to see where that beneficial ownership is lying. If it is the investment is coming indirectly from China. If it is coming directly from China, then even the 1% regulation will fall into the picture.
A non-resident may invest into India either through the debt instrument route or through the non-debt instrument. So NDI rules define non-debt instruments as investments in equity instruments of public, private or unlisted or listed companies, capital participation in LLP, contribution to trust, units of REIT, AIF or depository receipts issued against equity instruments. Now coming to the definition of equity instruments under the NDI rules. Equity shares, compulsorily convertible instruments, share warrants, everything is considered as equity instrument. Even a compulsorily convertible instrument like CCPS and CCDs are subjected to the norms of pricing guidelines similar to equity. This is a deviation from the Income Tax Act, wherein convertible instruments are not given the recognition of equity, but it is treated as debt till its ultimate conversion into equity.
Under the SEMA regulations or FDI regulations, all kind of convertible instruments, whether CCDs, CCPS, are considered as equity instruments, wherever there is a compulsory conversion attached to it. In case of optionality clause, then they are not considered as equity, but they are considered as debt instruments and subjected to ECB guidelines.
Instrument which has gained a lot of traction in recent times is the convertible note. It is typically or it can be issued by a startup which is registered with the DPIIT. It is a hybrid instrument and therefore does not require a valuation exercise or a valuation to be taken at the time of issuance. It is debt till its actual conversion into equity. It can be issued at a tranche of minimum of 25 lakh rupees and can be convertible or repayable anytime within 10 years from the date of issuance.
Then we converted into equity shares.
Now coming to the issuance of equity instruments, the considerations. In case of a listed company, the pricing guidelines apply. Similar for unlisted company also. The minimum price is to be determined as per SEBI guidelines. FMV is to be undertaken by virtue of the methods mentioned under the SEBI guidelines, and key compliances are filing of Form FCGPR. For unlisted company, the minimum issue price of the shares is the FMV of the shares of the Indian company. the internationally accepted pricing methodologies come into the picture in respect of determination of the FMV of the shares. Again, the key compliances include filing of Form FCGPR. There is, in respect of issuance, primary issuance to a non-resident shareholder, there is an option to have a partly paid up shares, wherein you pay 25% upfront and the remaining consideration is to be discharged in 12 months. With respect to transfer of shares from a resident to a non-resident, the minimum transfer value is the FMV of the shares, because the government wants the maximum value to come into India. It is reverse when you are transferring shares from a non-resident to a resident. It mentions that the maximum transfer price should be the FMV of the shares, so that you do not pay extra or there is extra erosion of foreign exchange. In case of both the transfers from resident to a non-resident or a non-resident to a resident, the pricing method, the FMV computation methods remain same. It is the internationally accepted pricing methodologies for unlisted companies, and for listed companies, it is the SEBI regulations which determine the market price or the FMV. Under both the circumstances, the FCTRS is to be filed in respect of transfer of the shares. There is an option in case of transfer that to settle the consideration on a deferred basis. 25% of the consideration is to be paid at the time of transfer, and the balance can be paid in 18 months. So an LLP registered under the LLP Act 2008 is eligible to receive FDI. FDI is allowed under the automatic route in all sectors wherein there is no FDI linked conditions. The way foreign investors can invest in the form of capital contribution, reinvestment of share of profits, or acquisition or transfer or profit shares in LLP. In respect of the infusion to be made in the LLP, the valuation is to be undertaken basis the arm's length price determined in accordance with the internationally accepted pricing methodologies.
So on LLP, like you mentioned, the FDI is allowed only where there are no FDI linked conditions. Now, under normal company route, for example, in SDRT, 100% FDI is allowed under automatically. But there are conditions attached to it that you need to fulfill. And therefore, you cannot have single brand retail trading 100% with 100% FDI in an LLC. Basically, under e-commerce, so, very interesting fact is that India is the only country where you will see under FDI regulation so much differentiation being created for the different forms of retail. So there is different regulation for business to business retail, which we call as wholesale trading. There is different regulation for B2C retail, which we call, business to consumer, under which also we have two forms, single brand retail trading and multi-brand retail trading. Regulators were not happy with these kind of differentiation, so they created marketplace e-commerce entities. Basically, these are entities that are not doing any kind of retail trading, but just facilitating retail trading between a buyer and a seller. In common parlance, this is something what Amazon and Flipkart does. And now there are, of course, a lot of other players also that come into the picture. So these regulations were also introduced by the government somewhere around 2019. Till that time, there was no clarity in terms of how these large entities are doing marketplace business. Till that time, we were taking a call that these entities are basically providing services. And most of the services actually fall under 100% automatic route. And therefore, what they were doing were 100% under automatic route through the FDI route. So the government in 2019 came out with very clear guidelines with respect to what is a marketplace entity under the FDI regulation and what conditions those marketplace entities need to satisfy to comply with the 100% FDI route. So this is the typical model what a marketplace entity is. Basically, a marketplace entity is a technology company that is providing an online platform to the buyer and the seller, so that the buyer and seller can come on one platform and the buyer can purchase what they want and seller can sell what they want. The marketplace is not just providing that platform, but also providing the payment collection mechanism through which the buyer is making payment to the seller. So this is something which is allowed under the FDI regulations. Any person with FDI can do up to 100% under automatic. But they impose certain conditions to it. One, the marketplace entity cannot have inventory. That is, they cannot have stock in their books. They had come up with regulations on the inventory-based model, but in the interest of time, I'll just cover what is currently considered as inventory-based model. So basically, they say that where the marketplace entity or any of its group entity sells products to the vendors that are registered as seller of the marketplace, and the purchases of that seller. So we have to look at for the seller. The seller purchases more than 25% of its total purchases from the marketplace or the group company of the marketplace entity. Then it will be assumed that the marketplace is maintaining that inventory, and therefore the marketplace will be considered an inventory-based marketplace. That is something which is not allowed. Okay. Practically, all the marketplace entities that are operating in India are actually, undertaking this compliance. They do not either sell to their vendor, their pure marketplace, or wherever they are selling, they ensure that it is restricted to less than 25% of the purchases of the vendor. Then any entity which is a group entity of the marketplace is not allowed to sell on the marketplace. So it has to be only the marketplace or the group entity have to operate outside of that marketplace. That's the marketplace. Okay, I will just cover the important element. It's one more important element that marketplace entities have to do is that they have to take a report or a certificate from their strategy every year before 30th September. They don't have to submit it, they just have to obtain and maintain that certificate. So they are complying with all the FDI regulations which have been enforced with respect to the marketplace operations of the entity. So I think this was the last slide in our presentation.